Talking about a $2 billion loss by J.P. Morgan Chase. Jamie Meredith with Heifer & Tillotson. He's the Vice President of Heifer & Tillotson. Rob Wilson joins us now, Vice President of Blazer Capital Management. Rob, good to see you.
Good to see you as well.
Thanks for coming in. We didn't get your thoughts on this in the first segment of the program. So tell us, what are your thoughts about the losses that J.P. Morgan took?
So the magnitude of the loss, $2 billion, seems like a lot of money to the average person. But when you think about J.P. Morgan Chase has more than $2 trillion in assets, then it's kind of like saying somebody that makes $100,000 went and spent $100 on lottery tickets and lost it. So the magnitude isn't what worries me the most. The first thing that worries me is the surprise aspect of it. Jamie Dimon, the CEO, was just sort of chastising reporters for asking him about this just 4 weeks ago, and now, you know, a month later, it's been disclosed that they had this big loss. So that's troubling to me. And then second of all, it seems like the banks haven't learned anything from the financial crisis and are still doing this sort of derivative trading that got us into trouble in the first place and could head us in that direction again.
Almost the exact same thing as Jamie said about it. So financial investment advisors are on the same page about this. So I guess the FBI is looking into this. The story that I have says the major banking institution reported an approximate $2 billion loss. Flawed, complex, poorly reviewed, poorly executed, and poorly monitored derivatives trading strategy through the Chief Investment Office, a London-based bank. So as you said, these are all the things that we were supposed to put up stop signs for, yet they continue to go ahead. Jamie said earlier it's because the Volcker Amendment isn't in play yet.
It's not in place, and it's sort of skeptical as to whether if the rule was in place, if it would have stopped this sort of thing. So it's meant to curb proprietary trading, but banks are allowed to hedge their risks, and proprietary trading and hedging look a lot alike. And so it's going to be very difficult for them to determine one versus the other, even if and when the rule does take effect.
What about derivatives? Because that was such a bad word in the last 5 years. Now, though, we're still talking about them and they're still trading.
I spent a decade of my life in derivatives and structured products in New York, not with J.P. Morgan, with Citibank, and they're a very powerful tool. I describe them as a Ferrari. In the hands of a 16-year-old, they're very, very dangerous. In the hands of Mario Andretti, they can be very elegant and they can fit a certain purpose, but even in the hands of Mario Andretti, he can still wreck that Ferrari. So derivatives are very, very powerful. I don't think they're the evil beast that they are described to be. If done properly, they can satisfy a very important need. And the derivative market is immense. It's trillions upon trillions of dollars. So when trades go bad, you see a $2 billion trade relative to the size of the entire derivative market. But
we've
really
seen these horror stories in the news where these derivatives have caused the tumbling of governments overseas, school districts,
right,
local municipalities, because of bad investments, yet they're still out there.
Absolutely. And
how do you stop unscrupulous traders then?
Well, derivatives, one of the big misunderstandings with derivatives is they're a contract. You and I can enter into a derivative and it's just a contract. And that's the problem, is they are a contract, and most of the time they're off balance sheet because it's just a signed agreement between you and I, or one institution and the other. The market is maturing, so they are now becoming exchange traded, which will improve it because it adds a lot of transparency. But the biggest issue I see with derivatives is a lack of transparency, and it's very, very difficult to look at an institution and know what their derivative exposure is because it's, again, contractual. And if you were to add up all the contracts it has with its employees, you don't really know its obligation to pay or things like that because, again, derivatives are contractual transactions. So what I would love to see is a heck of a lot more transparency. So we as professional investors, we can get a better understanding of the derivative exposure, and it's not just a footnote on line 167 of the annual report. It's spelled out a lot better, and I think the market would respond.
Rob Wilson?
Well, the troubling part of that, when you talk about the size of the market, J.P. Morgan had $5.8 trillion in these contracts, and they have $2.3 trillion in assets on their balance sheet. So you wouldn't expect 100% of those contracts to go bad, but I think that's troubling when you're leveraged to a level of which more than assets that you have on your balance sheet. But the real question here to the average person is, do you want your bank where you put your paycheck every 2 weeks into and expect it to be there, do you want your bank engaged in these types of trades? And when we repealed the Glass-Steagall Act of 1999, which allowed investment banks and commercial banks to be under the same umbrella, this is the situation we were left with. But the important thing is, no one is making you keep your money at J.P. Morgan Chase or Bank of America or whatever. There are fine credit unions in your community that you can use to hold your money. There are alternatives that you can go to.
Lower risk, but also lower interest coming back on those investments. Can we put the horse back in the barn now that the door's flying open?
Well, again, I think it goes
going back to 99 Glass-Steagall, was he just talking about?
You know, I think the issue all comes down to the federal insurance. And even though my background is in derivatives, I don't like the fact that my tax money is at risk when these big banks take big bets. I don't think we should restrict investment banks from taking risks. I just don't want my tax money to be able to bail them out. Yeah. So I agree that there should be some sort of ring fencing to protect the depositors, allow the markets to do what they do, but protect the depositors and get my tax insurance money away from those bets.
Stockholders taking a hit. J.P. Morgan Chase, how bad was it? It's all relative, according to our guests, Jamie Meredith and Rob Wilson. We'll continue, and we'll talk about Facebook and the IPO and whether you should invest in that coming up on Night Talk.